Hello everyone, and welcome to this video, which is going to be the first of two videos that is specifically dealing with LO6, which is going to be written on the 16th of August 2023. So in the first video, we are just going to go through the paper. We're going to have a look at the solution. We're going to see how everything gets put together. And then in the second video, we're actually going to mark an attempt. So mark someone's attempt, and hopefully I can demonstrate to you where some areas of judgment may lie and how then you need to deal with those areas of judgment. Okay, so that is in video 2. This is video 1. I suggest that you watch them in order. So you watch video 1 first and then move on to video 2 because that will help you. Yeah, so let's get into it. Okay, so in this paper, we had two questions. The first question, so I'm not going to read through the instructions. You guys are experts at this by now. The first question was sort of a big calculation type question, and that was on beat limited. And so one important thing that we had to identify was the data that was given to us, right? So if we had gotten the question, we would have went straight to the required section, right? And then we would have read. So I've skipped straight to the required section. I'm on page 4. For those of you that are following on a mobile phone and can't see clearly. The required says, part 1 says, present the statement of changes in equity of Beat Limited, right? And that's, they've highlighted and italicized that specific name because that's going to become important, who we're preparing for a little bit later. And then it says, for the year ended 31 December 2022, in accordance with IFRS. We then told that we must round all amounts, all final amounts. We don't need to do the final column. Calculations must be shown, right? And comparatives, now this is the interesting part, are required. So you find that a lot of our questions, we actually say the comparatives or the prior year numbers are not necessarily required. But here, in this question, it says it is required. They are required. So it's important we need to try and analyze what the examiner is getting at by asking us to actually prepare the comparative numbers. And then it says ignore dividends tax implications. So it's interesting also that the examiner has mentioned a specific tax, so just dividend tax. So the question is, why just one tax, right? And so let's see if we can't sort of answer our questions after having read the required. So the first lot of information we get says that Beat is a reputable, high quality musical manufacturer of musical equipment. It then says they're listed on the JSE and they have a 31 December year end and they're not a VAT vendor, right? So there's no sort of surprises in that first paragraph. It's not something that it's sort of in all of our questions we have that, right? And then in the second chunk of information, we see that they have given us the equity balances, which we will need to prepare the equity statement. But they've given us the equity balances for 30 December 2021. Now we need to produce the one at 2022, but also the comparatives, which mean we need to go from 2022 to 2021, and then from 2021 to 2020. Right, 31st December 2020. So we need to do 2 years. They've given us the balance that sits in the middle of that statement, right? So that is so interesting. That's very important that we grasp that that balance is actually sitting in the middle of our proposed statement, right? Then we've got the figures there of the balances. We're not going to go through them in detail. And then we start to read, and it says And so I just want to jump to the solution. I'm just going to try and make the solution a little bit bigger for you guys so you can see. Um, but you'll see that in the solution, the balance, right, that the balances that we got were actually just popped directly in the middle of the statement because we had identified that it was the middle of the statement. And as an aside for marking, you'll find that that entire line only gets 1 mark. So we fill out those 4 figures and we only sort of get 1 mark for that. And that's because it's simply us plucking information out of the question and putting it um, into the solution, into our solution. So the examiner wouldn't give us a lot of marks for doing that, right? So so that's why we only got 1 mark. And then we start to read now about information on 2021, which is good. That means so they've given us the information that is supposed to go at the top of our statement, right? So let's have a look at what information this relates to. So it says firstly, it's Class A ordinary shares, as well as the non-cumulative convertible preference shares that we're going to be reading about, right? So with regard to the Class A ordinary shares, we're told that there's an authorized share capital of 23 million. Now, the important thing with authorized share capital, remember, authorized share capital generally doesn't change in a firm. It authorized share capital is the capital that the company actually is allowed to issue. Doesn't mean it's been issued. It just means they're allowed to issue the authorized share capital, right? And that's 23 million. It then says that the ordinary shares have voting rights, right? Which means they're basically the subordinate shares, and they also get a variable distribution, which means they're like normal shareholders. They're not preferred in any way, right? And then it says on 30 December 2020, so this is the opening balance, right? Class A ordinary shares comprised of 1 million Class A ordinary shares that were issued at 1 rand 75 per share at incorporation. Okay, so since incorporation, they've only had one lot of issues, and that issue was 1 million shares at 1 rand 75. That's what we're being told, which means we can just go directly to our solution and put that under the balance, the opening balance. We can say 1 rand 75 times 1 million, which is going to give us 1,750,000, and that we're going to get half a mark for doing. Okay. We then also read that, oh, and the other thing that I need to mention is with these half marks, they are only awarded to students that do the calculation. So you must have, for example, in this example here, you must have this calculation sitting somewhere in your workings, and then you can get this half mark. If you don't have this calculation, and if you worked out this balance, so you might have gotten the right amount, but you got to it doing the wrong thing, right? So you did you worked the balancing figure out, so you worked backwards and got the balancing figure, and that is the wrong thing. If you did that, then you won't get the half a mark, right? You're not going to get the half mark because that half mark is basically a bonus mark in this assessment. Okay. Then we told now on the 1st of February, there was a public offer of 500,000 shares, and the price that they were offered at was going to be 7 Rand 50. Okay. It then told us that there was an opening of subscriptions, right, from the time of 1st February until the end of February. So for 1 month, there were subscriptions were open. Now remember how this whole subscription thing works, right? So what happens is companies go out to the public and say, I want to offer you shares. The public gets an opportunity to select and purchase, right, these shares for a given period. And how that happens is you send in your money to the company. The company just basically collects that money. Those are called subscriptions. And then at the end of the period, right, of the subscription period, the company then allocates the money to different shareholders. So you can have basically 3 scenarios that can happen because of this. One, you can have what we call an under subscription or under provision of shares, where the amount of people that subscribed or applied for shares was less than the shares that we want to offer, right? Then you can have an oversubscription where there's too many people that apply for shares or subscribe for shares, and we don't have enough shares to issue, right? So that's called an oversubscription. And then in a very, very rare situation, you can just have a subscription of shares or an application of shares that is equal to the amount that you offer. Now, that very rarely happens in practice. Instead, in practice, you either have an over or under subscription shares. So anyway, we're told that by the 1st of March, right, which is when the subscription period that ended, the application period that ended, by the 1st of March, they received 4 million subscriptions. So that's what they received from the public, right? However, on the 15th of March, they had issued the 500,000 shares, the new shareholders, and the share issue costs represented 5% of the amount of shares that were issued, right? And then it also tells us that it is the accounting policy of this company to take the share issue costs out of retained earnings. The reason why that had to be mentioned in the question is because it's actually left up to the company where they take it out. So you find some companies might take it out of your share capital, and some companies might take it out of your retained earnings. So in this question, the examiner was trying to dictate to you where you need to take it out from, and so basically it's retained earnings. So let's have a look at how that is represented in the solution. So if you go to the solution, you see on the 15th. Oh, so the other thing I needed to mention was shares then are not issued on the date that the prospectus is given to the public. So it's not on the 1st of February. It's not when the subscriptions close on the 28th of February or even the 1st of March. Instead, it is only when the shares are allotted and issued to shareholders, which happens on the 15th of March. That is when we can say the shares are now issued. So that's important, that getting that date right is important. Obviously, in this assessment, you wouldn't be penalized if you got the date incorrectly, but it's important going forward when we start doing different topics in accounting. You need to remember that the date at which the shares are issued is the date that the shares are allotted to the actual shareholder, right? And sometimes they'll even say the shares were allotted and the share certificates were sent to the shareholder. So that is the date, that the shares were issued. Okay, so let's have a look at how this paragraph was represented in the solution. So the first thing is we've got this 3,750,000. That comprises the 500,000 shares at the 750 rate. That is what we are seeing there. Now, importantly, the 4 million is not in the changes in equity. Notice the question mentioned an amount of 4 million rand. Because what happens to the other 200 million? I mean, to 200,000. The other 200,000 actually gets paid back to those shareholders that didn't get a chance to get a share. So the money is returned to the shareholders because this was an oversubscription. So that amount does not appear anywhere here in your changes in equity statement. That 4 million doesn't appear. It's only the 3,750,000. And then we see the share issue costs being taken out of your retained earnings column, right? So the share issue costs, again, just 5% of the issued value. And that was taken then out of the retained earnings. Notice that it didn't say 5% of the subscriptions. Right? It didn't say 5% of 4 million. It said 5% of the shares that were issued. So therefore, it's 5% of the 3,750,000, not 5% of 4 million. Okay. We then told that there was a dividend, a total dividend given to the ordinary shares. Now that's important. Why? When we issue dividend to the ordinary shares, we are forced then to have issued dividends to the preference shares. So it's important that they told us that they issued a dividend to the ordinary shares. That means the preference shares also need to get their dividend. So we need to watch out. We're on notice to watch out for the for the preference share dividend. Right. Okay. Let's have a look at that. So here you'll see that we have ordinary share dividends right at the bottom, and it's 750. Notice this was the total dividend. So they didn't give us the dividend per share. Instead, they give us the total amount paid. So that's why you just see 750 appearing here. You got half a mark for copying that correctly from the question. Okay, then we see at incorporation, 5 million. There were 5 million authorized non-cumulative convertible preference shares. So these are the preference shares, right? They earn a fixed dividend of 75 cents share, which is interesting, right? Then we see that there's a non-cumulative the non-cumulative convertible preference shares are actually classified as equity, which means we apportion the dividends for part of a year. So that is going to help us when we want to calculate dividends, right? Notice so far they didn't mention anything about the shares being issued. They only told us about the authorized share capital. Then on the 1st of January 2021, which is part of the years that we are actually looking at, it says there was the first and only issue of the convertible preference shares since incorporation. So these shares had never been issued before. Right? They've never been issued before. Therefore, what would have been the opening balance on January 2021? What is the opening balance of this type of share on January 2021? If they've never been issued before, the opening balance should be nil or zero, right? So it's nil or zero, the opening balance. Right? Then we see that the shares were all issued to one company called Treble Limited, right? So this is the company we're working for currently is Beat Limited, and now they've introduced Treble Limited. And it says that the share price was 250 per share. Okay. We also hear that Treble had funded this purchase with cash reserves, right? Non-discretionary cash reserves means money in the bank that no one knew what to do with, right? So that's what non-discretionary means. There wasn't a task for the money to do, right? It wasn't a set aside reserve. It was just cash that they had in their current accounts, right? And then we're told that they measured in terms of IFRS 9, and they measure it through fair value, through profit or loss, right? Which is what we already learned about and what we know about is fair value through profit and loss. Okay. Then on the 31st of December, the preference shares got the dividend. Now, what dividend did they get? We were told in point 4 that the dividend is 75 cents. So that's the dividend that they got. And then finally, Beat had non-cumulative convertible preference shares, right? They were listed on the JSE and the shares were now trading at 315. This is important, right? So the shares were purchased for 250. The shares are now trading at 315. What has happened? The share value has increased, right? The share value has increased. Okay, so that brings us to the end of the 2021 information. Let's go and have a look at how they represented this information in the solution. So you have a look here and you see we knew the opening balance was zero. So therefore, this issue of 2000, this issue on 1 June of 1,250 Rand, that was, 1,250,000. That would have come in as the first and only transaction in this column of the changes in equity. And so we see that here as money entering the business, okay? Money coming into the business, that is what it is there. Now, also notice that the balance that we received, right? Let's go back to the question. The balance that we had received as the middle of our statement agrees to this 1,250,000. So now we know we're on the right track. We know we're doing the right thing because our balances are now adding up. Just to help you understand how we calculated the balance, we we were told that the price was, we had issued 250,000. We had issued the shares for 250, and they never really indicated to us the price of the shares. But we can work backwards, the amount of the shares. We can work backwards by taking 1,250,000, dividing it by 250, and that would actually give us the amount of shares issued. Right? Although we're not going to calculate it immediately, you're going to need to calculate it for the dividend. But it's just interesting that they never really gave us the amount of shares, and we had to sort of work backwards to get it, right? So let's now have a look at the dividends. So if you have a look at the dividends, this is what we're doing. We're taking the 1,250,000, we're dividing it by 250, which is the issue price per share. That gives us 500,000 shares. We then apply the 75 cents to the 500,000 shares that we had issued, right? And that is going to give us a dividend of 375,000. But remember what we read. Remember what we read in this sentence, where it says that the dividends must be apportioned for part of a year. Now, let's think about that. How many months has these shares been in issue for? So even though it says June, now a lot of people might have gotten stuck with this one and said, oh, June, 6 months. It was the beginning of June. So it's actually 7 out of 12 months. So there we go, 7 out of 12 months. We apportion the dividends for part of the year, which means the dividend that ends up in our statement is actually 218,750 rand. Okay. Right. Now we start getting information about, so if we think about how your solution would have looked at this point, you would have had like no information under revaluation surplus. You would have had some information under retained earnings, but basically the profit line item would have been blank, right? Because we didn't yet read or learn about profit. So we now are going to start working on the 2022 year, while the 2021 year is actually still incomplete, right? So that is part of the assessment. That's getting you to work with mental and intellectual agility, is to sort of do two things at once. And that is us working on both the 2021 and 2022 years sort of simultaneously, because that helps us with our understanding. Okay, so let's have a look at what's happening in 2022. So we see on the 30th of April, there's a capitalization issue, right? How does the capitalization issue work? They get one ordinary share for every 4 shares that were held on that date, being the 30th of April, right? So 1 share for every 4 shares on the date that they were holding. Right, and then they say there was a special resolution, and the special resolution concluded that the shares need to be issued at the prevailing market price. And the prevailing market price just happened to be 8.40 on that date, right? So how are we going to calculate, or what are we going to do with that? So let's go and have a look. So firstly, what is a capitalization issue? Let's talk about what a capitalization issue is. A capitalization issue is when a company, right, is trying to either pay less dividends or not pay dividends. And what they will do is they will say to the shareholders, what we're going to do is we're going to actually give you shares, right? We're going to give you shares as a reward, okay, for being an owner. Normally, we would expect companies to give dividends as a reward for being an owner, but now they're saying we're going to give you shares as a reward for being an owner. What that means is we, as a company, we can't take those shares back from the owner. So what makes sense is for us to move the amounts related to the capitalization issue out of retained earnings. Why? Because retained earnings represents an amount for which the directors have some influence over. The directors can decide what to do with prior year profits. Should we apply it and buy a new, for example, a new tractor? Should we apply it and invest it in another company? Like those are discretionary. Um, the directors have discretion over the amount sitting in retained earnings. However, the directors don't have discretion over the amount sitting in share capital. They can't decrease it without the permission of the shareholders. They can't increase it without the permission of the shareholders. They basically can do nothing with the share capital column without the permission of the shareholders. But when it comes to retained earnings, the directors have influence over that column. So what we're saying by giving these people shares is we're saying we're going to set aside, what we're saying by giving the owner shares, we're going to set aside some value, right? And that value you are going to be in control of. Right? You're going to set aside some shares in the form of value, and you're going to control it. So how it's represented on the statement is us decreasing retained earnings because it's value or money that the directors no more have influence over, and it's value or money that the shareholders now have influence over. So it's us decreasing the retained earnings and increasing share capital. Right? That is that's the reason why you find there's a decrease in retained earnings and then that increase in share capital. That's where the money comes from. Okay, so let's have a look then at what that might look like, right? So firstly, we add up all the shares that we've had so far, right? So we started off with incorporation of 1 million shares, and then in the prior year, so in 2021, we added 500,000, which gave us 1.5 million shares, right? With that 1.5 million shares, we divided it by 4. Why? Because it said here for every 4 shares, okay, for every 4 shares held, they were getting 1 share. We divided it by 4, and that means we would have issued 375 shares to the shareholders. The rand amount or the prevailing amount that the shares were trading at was 840, which would have given us 3,150,000, right? So that is the amount of the capitalization issue. The amount is not so important, but we need to understand what the mechanics is. Why are we decreasing retained earnings? Why are we putting it in share capital? The reason for that is we are doing that because we are saying this money is now, we're setting it aside. We are ring fencing it. We are putting it in a box, and that box is under the control of the shareholders. Right? So that's why we take the money out of retained earnings, put it in share capital, because we're setting it aside for the shareholder. And so the shareholders are getting these shares without paying for them. That's the idea. That's the idea behind capitalization issue. Shareholders get shares but don't pay for them. It's called a not for value issue. Okay. So that's the capitalization issue. Right. Let's look at the next thing. So the next thing talks about a conversion of 40% of the shares that were issued, the preference shares that were issued. Right. So 40% of the shares that were preference shares were converted. But how were they converted? They were converted into 6 ordinary shares for every 1 preference share. So 40% of the shares were converted, right? And each of those 40% of the shares were then given 6 shares, 6 ordinary shares. That's what we've been told. Okay. So how would we represent that on the statement? Now, the important thing is that the amount of shares transferred necessarily isn't important at this time. Instead, we can just simply apply 40%. So if you have a look at example or calculation 8, we just apply 40% to the total balance of the preference share, We don't need to work out the number of shares just yet. We're going to do that later when we do dividends. But currently, we don't need to work out the number of shares just yet. So we find that that 40% gives us 500,000. Notice what's happening here. We're saying this 500,000, the 500,000 represents a value that was previously owned by the preference shareholders, but now these preference shareholders have become ordinary shareholders. So we move them from preference shares into the ordinary share column, right? So it's decreasing preference shares and increasing the ordinary share column. So that is what we're doing there. Then let's have a look at what the question is telling us. Oh, then we're told that the ordinary shares then get a dividend of 20%, and the preference shares were trading at 5 Rand 15 on the JSE. So let's first deal with the dividends, right? So the dividends, the ordinary shares got a dividend of 20 cents. So how would we calculate that? Right? How would we calculate that dividend? Right? So let's think about it. We've got 5 million shares that we started off with in this year. We then converted, an amount of shares like 375,000 shares, right? We didn't convert it, we did a capitalization issue for it, 375,000. And then we converted 40% of the ordinary of the preference shares. So let's then have a look at this transaction, this calculation. So we start off with the 1.5 million, right? We then add to the 1.5 million the 375,000, which we got from the capitalization issue. And in addition to that, we've got another 1.2 million. How did we get the 1.2 million? It was the 500. It was the 500 shares which related to the preference shares, the 500,000 shares multiplied by 40%, right? Because remember, 40% of the shares were converted. That gives us 200,000 shares. We then multiply that by 6 because we told for every one preference share, we get 6 ordinary shares. That gives us 1,200,000 ordinary shares. We add all of those shares up, and we're going to get 3,075,000 shares. We multiply that by the 20% dividend, right? And we get a total dividend that needs to be paid to ordinary shareholders of 615. Okay, of 615. Then, now because we've issued to ordinary shareholders, that automatically means what? It means we must have issued to preference shareholders. We must have issued dividends to preference shareholders. So we start off by saying, okay, we originally had 500,000 preference shares. We then converted 200,000. So we're left with 300,000 shares. We can then apply the fixed dividend of 75 cents. And now the reason why we said it's fixed because it won't change from year to year, and the examiner doesn't need to tell us, right? The examiner doesn't need to tell us about the shares. So that would have resulted in 225,000 shares that, or 225,000 Rand of dividends that represented the dividends paid to shareholders that remained throughout the year. So this was the dividends paid to shareholders that never changed. They were always preference shareholders. But then we converted that 200,000 preference shares. So we need to calculate a separate dividends for them, right? And how do we do that? We say 200,000 shares multiplied again by the 75 cents, which is the normal dividend. But because the conversion happened on the 1st of May and the year end is in December, that means 4 months have passed. So that would have been January, February, March, April, 4 months. We divide that by 4 multiplied. We divide it by 12, at least multiplied by 4. and that gives us 50,000. We add that to the original dividend we had calculated for the shareholders that never changed, and we get a total dividend of 275,000, which you then see appearing under retained earnings because it's decreasing the amount of retained earnings. Okay, now in point 3, we get some information about the revaluation model. They say that there was land, okay, land was revalued, and we then told that the land was purchased on 1 January 2020. So that's at the beginning of the period that we are reporting for. And it was 1 million, the land cost 1 million rand. Then by the end of 2020, it was 250,000, which means what is then going to be our opening balance? Because that is where our opening balance starts. Our opening balance is 250,000, and it's the difference between the 1 million purchase price plus the 1,250,000, right? We then see it increases by 50, right? 50,000 in order to end up at 1.3 million, which means there should be an increase in the residual, the revaluation surplus of 50,000 in the 2021 year. And that's what we find there. Notice how this is now 300,000, which is equal to the difference between the purchase price and the most recent revalued amount. But obviously then at the end of the current year, it goes to 1.45 million. So we find we have to increase this revaluation surplus again by 150,000, which gives us a total closing balance of 450,000. Okay. We also say that there have been no other items in OCI for all 3 years. There have been no other items. So there's been no other revaluation surplus. Nothing else has affected the equity statement. Right. So the last point, it says profit before tax for the year of 2022 was 2.1 million. The profit before tax was calculated before any of these transactions were taken into account. But if you think of it, there actually won't be any effect on the profit before tax because we've been dealing with dividends, we've been dealing with issues of shares, we've been dealing with share issue costs. All of these don't end up on the income statement. All of them don't end up on the SPLOCkie. They all are balances. They all are things that affect the changes in equity statement. So that statement there put in by the examiner was actually to test, do we as students know that, dividends, for example, doesn't go into the SPLOCkie? Do we know that share issue costs don't go into the SPLOCkie? That is what that was attempting to test, you see? And then we told that for the year ended 2022, the tax was correctly calculated at 400,000. Now we know that the amount that goes into the changes in equity statement must be the amount net of tax, or the amount less tax. So we would have went 2,100,000 minus 400,000 rand tax. And you'll see that in 2022, we actually have the 1,700,000 that we would expect to see there, right? And then finally, they give us for 2021, they don't ask us to do any calculations. They just say the profit after tax or profit for the year is 1.6 million. And we just pop that 1.6 million in there and get half a mark for it. Okay, then there were also 3 marks available for your formatting. So there was basically a mark for you to write down the name and the correct statement to get the columns all right, get all the columns that we required. And then in 2021, we gave you half a mark for writing all of this stuff down. But in 2022, we were only interested in the capitalization issue and the preference shares, which means none of the other labels attracted any marks. So if you only had these labels but missed out these two, right, in 2022, you actually would have gotten 0, okay, in terms of presentation, I mean. And then the ordinary share dividends, you get half a mark for indicating the ordinary share dividends. And that is basically required 1 of question 1. Let's have a look at required 2 then of question 1. So it says, must prepare the journal entries for Treble Limited, right? For the year ended 2021 only. So we're only looking at information in point 1, not in point 2. So 2021 only. They reiterate that in the note by telling us that we must limit our answer to 2021, only look at points 1.4 to 1.6. And then the usual sort of stuff that we expect to see when we talk about journal entries is we must make sure that we tag each account name. We must make sure that we date the things correctly, the journal entries correctly. The tax, we ignore all tax implications and assume all amounts are material. Okay, now let's then have a look at what this would look like. Now we know, because we were told here, right? We were told here that the purchase price was 1.250 million. So we can say, and also we were told that they used non-discretionary cash reserves, which basically means money in the bank, right? So you see on the 1st of June, we are crediting bank, meaning the money is leaving our bank, and we debiting an investment in Beat. Now remember, this is in the books of Treble Limited, not in the books of Beat Limited, not in the financial records of Beat Limited. Okay, it's in the financial records of Treble Limited. So we are saying there, the investment in Beat Limited, we giving, so you get a half a mark there, half a mark there, and a half mark for the correct amount, which really we should have gotten because it was given to us, right? Then whatever dividends you had calculated in required A, right? So even if this amount is wrong, right? In required 1 at least, even if this amount was wrong, if you correctly transposed or copied it into the next journal entry, you would have gotten the amount, the method mark for the amount, right? Or the mark for the amount. And now let's think about this. What would it be? In what you call it, the books of Treble, this could have been, and we know that it wasn't paid on time, right? So basically, let me come. There we go here. Point 1.5, it says that the payment was only made in 7 January. So we know that the dividends weren't paid on time, they were paid late. So therefore, we need to have some sort of debtor or receivable being debited, right? So here we chose other receivables because we didn't choose trade receivables because it's not part of trade. Or you could have gone like accrued income or accrued dividend income, something like that, right? Not bank. Bank is wrong. So if you got bank there, you're wrong. And then your contra account is going to be dividend income, right? And remember what I said is the amount is copied directly from your required 1. And then the last journal entry, and this is basically the key journal entry in this required in this section, is for you to revalue the investment, right? How do you revalue the investment? You have a look at what it was purchased for, or what was the old price. The old price was 2 Rand 50. The new price is 3 Rand 50, which means it's gone up by 67 cents. I mean, 65 cents. If it's gone up, I need to increase the value of the asset. So I'm going to debit the asset, which is what you're going to see here. Notice the name here is the same as the name when we purchased it. So it's the same asset, right? So we're increasing that asset. And our credit is going to be a gain of fair value adjustment, right? Our credit is the gain of fair value adjustment. So this 1.5 is actually a mark. when you convert it into a PDF, it doesn't reflect like how it reflects in the actual solution, the soft copy of the solution. But the mark 1.5 marks is allocated to this 325,000, which is calculated by 500,000 multiplied by the difference between the 3 Rand 15 and the 2 Rand 50, right? That gives us our required. Okay, so that is question 1. In terms of question 2, so question 2 it was MCQ questions. Let's just have a look at the solution, and we'll go off the solution, right? So LIFO, we know for a fact LIFO is not accepted in any of the frameworks except US GAAP. So in this question, they were asking us which one accepts LIFO, and US GAAP was the correct answer there. Which of the following are qualitative characteristics of the IFRS for SMEs? Consistency. IFRS for SMEs talks a lot about comparability. Accuracy really wasn't. Going concern assumption, although it was implicated, it wasn't a qualitative characteristic. And legal form over economic substance. In fact, what we need to record is the economic substance over the legal form. So the only one that we can accept is basically B. Which so in IFRS for SMEs, which asset can we use the revaluation model for? The correct answer is A, which is basically any PPE for which we can get the revalued amount, right? Question 4 asks us about basically which of the frameworks require us to disclose write-down. And so we know that SDGs is not really an accounting framework talking about inventories, so that definitely can't be part of our answer. And therefore, if that can't be part of our answer, then all of the above also can't be part of our answer. And IFRS for SMEs actually has a reduction in terms of disclosure. So they don't want you to disclose a lot. So specifically, for example, they don't ask you to deal with the reversal of inventories in IFRS for SMEs, which means we know IFRS requires it, and GRAP is based off IFRS, right? So GRAP uses or relies on elements of IFRS in its development. So therefore, these two will be part of the answer. So the only one we need to think about is the US GAAP, a US GAAP at least. And then when you look at the differences that were in your class notes between IFRS and US GAAP, you'll find that this was not mentioned. So therefore, by its omission, means that therefore it must be the same. And so your 3 answers were A, B, and E. A similar type question here, saying which does not require the disclosure of the judgments involved in the depreciation method and estimated useful life. We know that SDGs must be one of them because SDGs is not a reporting framework, and here they ask us which one does not require. So clearly SDGs must be there. And then the disclosure is a reduced disclosure in terms of IFRS for SMEs. So that is also one of the answers. Okay, so Zillow Limited is actually trying to test our knowledge of dividends. So in Zillow Limited, we're told here that there's 100,000 ordinary shares. They receive a dividend of 25 cents per share. However, the dividend wasn't really paid, right? The dividend wasn't actually paid at year end. So the dividend was basically outstanding, you see, at year end. So how are we going to report this? How are we going to report this in the financial statements, right? And then the statement say, okay, the first is we take the 25. So 25 has come from 25 cents times 100,000 shares. We take the 25,000 Rand and, we report it in this blocky. Now we know that's wrong because dividends is an equity distribution. and the Splocky only has income and expenses. And specifically, expenses says we must exclude distributions, right? So that can't be right. We then say, okay, what we're going to present it still in the Splocky, but only next year when it's paid. That also can't be right? So that's wrong as well. Then the last one talks about, dividends needs to be disclosed again in the Splocky, and that's because of the matching principle. Right? That's wrong. And then D basically says it's not disclosed at all in the Splocky. And that is the correct answer. It's not disclosed in the Splocky. Instead, we know it ends up in the changes in equity statement. Okay, so that's D. And then CryptoZoo Limited, we got the opening and closing balances of inventories. We got the purchases of inventories during the year. We've got some returns. We're also told that the following were not or was not actually recorded. And the stuff that wasn't recorded was the bulk discount of 5% on all purchases and that returns that we just saw of 35,000. Right? Now, what we would do in order for us to calculate cost of sales is going to be the balancing figure in the inventories account, right? So it's going to be the balancing figure in the inventories account. So we would say, let's add the opening balance, let's minus the closing balance, because the closing balance is still stock on hand, therefore we can't include the closing balance. So we add the opening balance minus the closing balance. We will then add any purchases, okay, but we need to decrease those purchases by the discount, right? And then deduct from cost of sales any returns, because that returns are also going to form part of the amounts on hand. Okay, so let's have a look at which answer then is correct. So if you have a look at answer G, here we are adding the opening balance, adding the purchases, deducting the returns, and deducting the closing balance. So out of these transactions, or out of these calculations, G is the correct one. And if you did G, you get 2.5 marks. Let's talk about why the others are wrong. The first one is wrong because someone has incorrectly treated the opening and closing balance. Instead of adding the opening balance and minusing the closing balance, they did the opposite. They added the closing balance minus the opening balance. And then they also didn't know what to do with the return. So they added the return to cost of sales. That's wrong. Part B, or option B, they just did the balances incorrectly. Then C, they didn't remove the rebate, the 5% rebate. D, they treated the what you call it, the return incorrectly again. Right? So here they added the return, but in E they didn't. They just ignored the return in its entirety. And when it comes to basically F, they applied the return, the discount, to the returns. Okay, so that's basically what they did wrong. Okay, that's what they had done wrong. And so yeah, that's the test. I hope you guys got some value from this video, and make sure that you watch the next video in which we actually do some marking, try and mark someone's paper. Okay, thanks guys. All the best. Bye bye.